Welcome back to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Phil Tripatowski.
And I'm James Sivko.
It is March. There are bombs being dropped all over the place, and there are knowledge bombs that are going to be dropped here on the Automotive Market Minute like never before. Seasonally adjusted annual rate. We're going to talk about the Fountain Ford prediction versus Wall Street, dealership performance, and we'll also show you a sneak peek at where March is for the first 10 days. Recession risk, question mark? Tariffs and trade deficit, lending standards, EV outlook, and the deals that are sitting on the market just waiting for you. Let's go. If you enjoyed this video, hit subscribe. It's free, and we want to make more videos that you love for people just like you. Thanks for the support.
Who beat the street?
Can you believe the little engine that could stood up to Goliath, Wall Street, and paddled them? Wall Street predicted 15.2 million sales, and Fountain Ford predicted 15.8. And I have a question, Mr. James Sivko. What was the number?
15.8.
15.8 million seasonally adjusted annual rate. That was our guess, and we hope to continue to predict where the market is going. Just a little tidbit for you there to start off. Go ahead, Phil.
Monthly, Fountain Ford will be releasing a prediction trying to forecast the SAAR, and we intend to continue to beat the street month in and month out. Steven, how did February turn out?
February was quite interesting, and something I'll be talking about in my ending monologue here is day 54 and what exactly happened to the market. So first of all, February versus January. January, the freeze, the very concerning month. Let's go to February. Appointments were up. New sales were up. Used sales are up. And don't forget, we have a couple of less selling days. And then you look at year over year and you're like, okay, we're holding our own. We know profits are compressed, but we are holding our own. But I have the first 10 days of March for you to take a look at. Now, looking at the month of March, so this is the first 10 days of March versus the first 10 days of February. What's very important here is this. New sales are up, so we continue to build momentum after a slow January. Used sales up 15.3%. Looking at a February that was already up over January. Now, I'm going to be talking about day 54, talking about tax returns multiple times as we go through the Automotive Market Minute and what's happening with people that are underwater on their vehicles versus a record $4,100 average tax refund and what you need to do. But one last little element here. Look at the year-over-year sales. New sales are down. Used sales are down. So it was definitely a hot March last year. I know a lot of dealers set records last year. And we this year continue to build momentum. But there is a little bit of slow year over year, not just in profits, but also in total unit sales through the 10th of March. Go ahead, gentlemen.
Perhaps we will see another Liberation Day, a little different than last year when all the tariffs were released in the Rose Gardens. But since our last market minute, there has been a tremendous amount of news that has came out. The Supreme Court ruled against Trump's global tariffs. Trump reenacted them almost immediately. Autos will still have tariffs in place moving forward. And the thing that the entire nation has been talking about, the U.S. has invaded Iran. James, what are we looking at for the rest of 2026 with all this conflict going on in the Middle East?
Pre-war, we were expecting a baseline. If we were to break it down into the car business and rate it from 1 to 10, we were expecting at least a 7 with some upside to an 8 or a 9. These are recession odds in 2026 for the economy generally. This is a data series that should hang out around 15%. Anything above 15% is taking in opinion that, yes, we are going to have a recession, and certainly recession odds have turned higher. The whole exercise is really what is the area under the curve of oil. Oil prices have spiked, and if they stay high for a long time, we'll get a recession. It does it every time. You can see here, this is gas prices, and gas prices have really just started their move. They are up only about 50 cents a gallon for regular nationally. Certainly, this is more for different grades of gas like premium, or it may be more from where you are watching the Market Minute. But we have started to see this move and would expect some follow through here over the coming weeks, no matter which way oil prices go. This is the effect, and this is important for us in the car business. This is the 10-year note in orange and oil in blue. And if you look at the move in oil, it implies 10-year rates 50 to 60 basis points higher. So again, if oil prices stay up here, we may start to see interest rates that won't cooperate with the Fed, and we may see the long end blow out as they speak and long interest rates move.
Quick question here, James, from the peanut gallery. We know that automotive loans normally hang out between 3 and 5 years in general. How would this affect 3 to 5 year loans and interest rates?
We have inflation break-evens. So this is the difference between two bond prices, and it's a pretty wonky series. Kind of underestimates inflation over the long term, but direction's important and movement is important. And you can see here, this light blue line is 5-year inflation expectations. And so no matter what the Fed does with shorter term interest rates, we can expect to see, if this continues, higher 5-year interest rates. It looks like the move here is about 40 bips.
40 basis points for all the people out there.
This is an interesting breakdown here of what outcomes might be in the war. Certainly you never know. The fog of war is definitely upon us. This is from our friends at Bank Credit Analysts, but it looks like 30-70 bad. So don't like looking at that chart, but they kind of walk through what the showdown might look like. And so we may have a pretty big oil crisis here, and we may see gas prices that move $1, $1.50, or $2 a gallon higher, and that's going to affect our consumers. Going back to the recession story, just one of the things about these gambling markets is they've only been around for a while. And I've noticed that when it comes to bad economic news, they like to overprice, what might happen in the future. So, they launched this 2025 contract. We did not have a recession in 2025. They launched a contract, it trades up, and it forms a really big opinion about potentially having a recession, and then one never shows up. So in any given year, you've got about a 15% chance of entering into a recession. Now, we've been lucky because we've been part of a 17-year expansion cycle with just a few pauses. So a recession will come. It's just a matter of when, and we certainly hope it's not this year, just for the sake of the car business. This is a neat chart. So the spike here all the way down, well, this is our trade deficit. Lower here is more negative. This is billions of dollars per month flowing out of the US. This is a lot of things that cause this, NAFTA and trade agreements and things, and really just a hollowing out of the US economy. And so it's a net negative. The amazing thing about this administration is they've got this turned around. So that giant spike you see downward is everybody rushing to import things in front of the tariffs. And the giant spike you see upwards is the effect of the tariffs. But if you take a look at this and you may put a little arrow here and get rid of that noise, we've turned the trade deficit around. And that's something we really haven't done in a long time. And just think of this trade deficit as being a subtraction from the economy, and it's a smaller subtraction going forward. So this is part of the economic plan, and we hope that it works.
With regards to the trade deficit, and then what Phil talked about earlier when he talked about the Supreme Court's ruling and then Trump's actions afterwards, for those of us like me that can only comprehend so much, can you tell me what you think is going to happen with tariffs going forward?
This administration is committed to tariffs. The Supreme Court said, don't call it an emergency and invent tariffs. The administration said, fine, we're not calling it an emergency anymore. We're using our executive power to keep them. So the tariffs have been very impactful. They've shrunk the deficit. And so I think that we should expect for and plan for tariffs into the foreseeable future.
Sounds like the low is in, and the executive branch has a number of tools within their tool belt to continue to leverage and ensure that the tariffs are still in place. Does that sound accurate?
Absolutely.
James, talk to us about the current lending conditions in the automotive space.
So this is an interesting graph. It's the Senior Loan Officer Survey. Banks aren't the whole market. They are just about a third of the auto loan market, but they're a little bigger in the prime space. And this is just asking the credit officer at the bank are your loan terms tight? And that would be up on this graph. Or are they loose? And that would be low on this graph. So whether we think they're tight or loose, somebody somewhere way up at the top of the building in a bank thinks that they are relatively loose and in a pretty standard range here. And you can see they didn't take this survey back in, say, the '08 financial crisis, but the green line, which is us, which is autos, certainly rhymes with these other lines. It should be pretty sanguine in terms of trying to get prime loans closed for customers. The banks are out there, they're ready to deal. All right, this is some good news from dealers here. This is heavy truck orders. These are trucks that are just bigger than pickup trucks. Of course, orders here lead sales, as it does anywhere. But the fun part is this is adjacent to pickup truck sales. So we should, at least this was a pre-war data set. We are still expecting a really good springtime for pickup truck sales here in the US.
And let's talk about the bloodbath going on with EVs right now.
Bloodbath and EVs is an opportunity. And we have a few graphs here for your used car department, and your used car hat needs to be firmly on your head when we're thinking about this. So lots of EVs are leased. EV returns are becoming a bigger part of the lease market. But as we all know, and we have all seen all over the place, the value of EVs coming back on leases are plummeting. And the value of used EVs in general are plummeting as well. So this is a used car alert here. ICE vehicles over 3 years tend to depreciate around 42%. And look at these EVs that are coming in. So the EVs that are coming in this year are down 56%. It's probably closer to 60%. Our source for this was a bunch of electronic vehicle fans. Same thing in 2027, probably 60% as well. The difference between minus 40% and minus 60%, if you think about that residual, feels like a 25% discount. And that's what you're seeing in used cars. So if you don't have a big EV practice, this is an opportunity to move units. If you're thinking about putting a charger on your lot, maybe do so over in the used car area.
Fantastic job there, Mr. Sivko. To wrap things up for March, it is time to stop looking in the rearview mirror and start looking at the bridge right in front of you. We've officially crossed day 54. This is the tipping point where billions of dollars in tax refund liquidity hits consumer bank accounts all at once. Now, we're already seeing the impact. You remember what I said earlier? Early March data shows used sales are already up 15.3% compared to the start of last month. For the first time in a long time, the banks are actually leaning in to help you, with lending tightness dropping to its lowest level in years. But here's the reality check. While your customers are walking in with a record $4,124 average refund, they are also carrying an all-time high of $7,214 in negative equity. The tax check is a massive win, but it isn't a get-out-of-jail-free card anymore. It only covers about half of the average underwater trade. Your mission this month is to be the bridge for that remaining gap. I have some ideas for you. You first have to move fast because the fog of war is thickening. With the strikes in Iran creating a 70% probability of a massive oil shock, your customers are going to get defensive the moment gas prices spike. Now, what did we talk about with regards to used EVs? This can be your advantage. This is where the used EV game becomes your best friend. What you think? Used EV values are converging at approximately $25,000. We'll call it the $25,000 sweet spot. While the rest of the market is panicking about $5 a gallon gas, you should be the one offering the solution. These feature-loaded, low-cost EVs are the perfect hedge for your lot to keep that day 54 momentum alive, even if energy prices go vertical. The money is in their accounts. The banks are ready to buy, and you have the inventory strategy to win. Use this window to restructure those trades before the news cycle changes the math. On behalf of my esteemed colleagues, Mr. James Sivko and Mr. Phil Chibotowski, my name is Steven Dragella, and we will see you again next month on an action-packed Automotive Market Minute. Out.